Hello, this is Russ Morgan, and today we're going to be talking about where I save and grow money and keep the government's grubby hands off of the growth, and I'm talking about taxation. But here's the key. It doesn't keep my ability to access the money so that I can use it for the benefit of my family. We are all looking for better places to grow money, while minimizing the amount of taxes that we're having to pay on it. J.D. Rockefeller says, it's not about how much money you make, but it's about how much money you keep. Unfortunately, the amount of money that we're getting to keep every day is getting smaller. I heard an economist say the other day, if we considered federal taxes, state taxes, sales taxes, tariffs, usage taxes, etc., close to 50% of our income is going toward taxes. That's a pretty big hurdle for us as we're trying to find ways to grow wealth. This all started with a temporary tax created in 1913 that had a max rate of 7%. As you can tell, it wasn't temporary, and the max rate has been as high as 94% following World War II. Unfortunately, today's advice is teaching people to put their money into taxable accounts, or even worse, kicking the can down the road to a future date by deferring taxes and hoping that our government will leave less money in the future than they do today. Now, I'm an optimist, but as our country approaches almost $20 trillion in debt, the outlook of taxes going down for us doesn't look good. Most of the people I meet have almost 40 to 45% of their income going toward the government in the form of taxes or to accounts that the government have created, like 401ks and IRAs. Now, if you take a step back and look at that equation, it doesn't look good. Why are we sending money to accounts that the government created? That's right, the government created the Revenue Act of 1978. In this act, it provided the ability for employees to defer compensation into an account without having to pay taxes on it. That's where the 401k, the 403b, and other what we would call qualified plans were created out of. Now, if you did that in 1981 and your tax bracket was 50%, like the top tax bracket was, and then in 1987, you retired when the top tax bracket was only 28%. As you might imagine, that would have been a win for you. However, if you took money out of the account in 1980, if you put money in the account in 1987, and you retired in 2016 when the top tax bracket was 39.5, yeah, that didn't work out quite as well as you would have hoped. Things have changed. Our climate is definitely different than it was in the 80s, but yet we continue to apply the same advice that was given to our parents and our grandparents. Me personally, I've opted out of that system. I'm no longer participating in these government-mandated accounts. The fact that they have created the problem, which is taxes, and then turned around and granted as an exception to that problem through these qualified plans, that seems too fishy to me. Something's not going to work out, and I'm not going to be a participant in it. What I decided to do is I created what's called specially designed insurance contracts. This is where I put my money, and these are with insurance companies that predate the IRS. These companies have been around almost 200 years, and if you consider that the IRS was started in 1913, these insurance companies have favorable tax treatment because of that. Okay, so what is a specially designed insurance contract? It's a dividend paying whole life policy that is designed to increase cash. Cash is the king of all things for us. I want to try to create as much cash in my insurance policy as possible while reducing the death benefit to the lowest possible amount that the government will allow me without calling it a tax loophole or a modified endowment contract is their term. Designing an insurance policy that's maximized for cash and minimizing the death benefit gives me lots of advantages. First and foremost, my insurance policy is guaranteed to grow. Now, I was in the investment world for many years. The word guarantee is not available on securities, but in the insurance policy, it is. So I have guaranteed growth, which is a huge thing when we're looking for a safe place to warehouse wealth. Well, in addition to that, I have the ability to have tax advantages to where the government actually does not tax the growth of my money. And if I set it up correctly, I actually can get it out without paying taxes. It also can be protected from creditors, which when we're considering the litigious states that we're in these days, it's always important to reduce the amount of access our creditors could have in the event our businesses fail or we were in a lawsuit for some other purpose. I can use the money as collateral, and when you're getting loans, this is always key. But last, it's liquid. This is the one thing that I can't express to you enough, that our money needs to always be liquid. And if I do throw in one other big, huge plus here, I don't have to wait until I'm 59 and a half to access it. I can use the money instantly, anytime I want to, without penalties. The more money I can put into these contracts, the greater access I get to them. I can use the money in many different ways. I can do withdrawals, or I can use loans. I frequently use loans in my personal policies to buy real estate, to invest in different business ventures that come along, or to just lend money. Lending opportunities is a great place. If you think about it, it's the one business that never goes out of business and is recession proof. Now, I mentioned that I take loans, and that's probably going to catch a couple of you off guard because we're typically taught that loans are a bad thing. The reason I take loans, though, is because I understand how compounding interest works. If you think about it, compounding interest is a curve that's constantly growing our money each and every day. Well, if I asked you, when would you ever want to stop compounding interest on your money, you would say never. But unfortunately, that's not what traditional financial planning is teaching us. It's teaching us to save our money into an account to when an opportunity that does come along, that then we empty that account and then go invest in the new opportunity. Well, yes, maybe the new opportunity was better than the first place we had our money, but we only have one of those two accounts growing. So this is what I would call an or asset. When I use these insurance contracts, I don't have to give up the growth on the money. My compounding curve can continue to happen every day. Let me show you what I'm talking about. So if I'm saving money into this insurance contract that's guaranteed to grow, then I can find an opportunity that comes along and I can take a loan against this to invest in the new opportunity. Now, I have both the growth on this asset as well as the growth on this aspect. And when I'm talking about taxes, and we can get into this at another date, the use of borrowing from one asset on another can help reduce the amount of taxes that I pay. Just ask your CPA about it. That's why I call this asset an and asset. So just as a quick recap, I use an insurance company to save and grow my money with. When new opportunities come, All I have to do is I use my account as collateral, and I transfer those dollars from the insurance company into that new opportunity where I have growth on both my money in the insurance policy as well as the other investment. I hope this makes sense. If you want to see how insurance loans work at more detail, watch our videos that cover that by subscribing to our YouTube channel.